Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're tackling something quite interesting, actually. We're dissecting the volatility in a sector you'd normally think of as rock-solid frozen food.
Exactly. We're talking about Nomad Foods, ticker NOMD, on the New York Stock Exchange. They're this huge, sort of quiet powerhouse in Europe.
Yeah.
You definitely know their brands. Bird's Eye, Findus, Iglo.
Yeah, these aren't small names. They're absolute staples in European households. Nomad Foods has a massive footprint in the CPG sector, consumer packaged goods.
Right. And it's a business model built entirely on convenience, long shelf life. You'd expect it to be robust, not really tied to economic cycles.
But that's the puzzle, isn't it? If you look at their stock over the past few years, it's been under surprising pressure. It's down quite a bit.
And that's the core paradox we really need to dig into today. Why is a company that basically sells peace of mind, quick, nutritious meals you keep in your freezer, why are they facing such strong headwinds?
We've gone through a pile of their recent investor communications, especially the Q2 2025 earnings results, and looked at what analysts are saying. And they're pointing to a really bizarre, almost unbelievable culprit: record-breaking warm weather in Europe.
It almost sounds like an excuse, doesn't it? But the data behind it is actually pretty compelling. We're not just talking a few hot days here and there.
Yeah.
This was a genuine, climate-driven shock that really hammered their business.
So our mission for you, the listener, is to carefully unpack all these challenges. We need to separate out those big, unexpected external things, the heat, the cost inflation it triggered, from the internal execution issues that management has actually been quite open about. Things like problems with their ERP systems, their planning systems, and managing inventory.
And just as importantly, we need to look hard at management's plan to fix things. It's pretty aggressive, really a two-pronged approach. First, stabilize the core business, get volume growing again, and second, maximize shareholder value, which, given the background of the founders, we'll get into that, is a really significant piece of the puzzle. Potential activism is always sort of hovering there.
Okay, let's dive right in then.
Yeah.
All right, let's start right at the beginning, the foundation. Because understanding how Nomad Foods was actually created is pretty critical to understanding its potential, maybe even its end game.
Yeah, this wasn't some company that just grew organically selling fish fingers for decades. It was constructed really through a series of pretty rapid acquisitions. And the people leading that charge were two very experienced investors, Nomad Gottsman and Martin E. Franklin.
And that's the key difference, isn't it? Their background isn't typical slow and steady CPG leadership. It's more like private equity, focused on value creation.
Exactly. Noam Gosman especially has a remarkable track record. He co-founded GLG Partners, a major hedge fund success story. They sold it for, what, $1.6 billion back in 2010?
Huge number.
Yeah. And today he runs Tom's Capital Investment Management. They manage over $2.5 billion.
Okay, so that immediately brings up a really interesting angle for investors, right? The sources we looked at draw a pretty clear line between this and Tom's Capital's history of activism. The big example is Kellanova, the U.S. snack company. Tom's Capital took a big stake, and not long after, Mars Inc. came in and bought Kellanova. Huge deal, over $35 billion.
And crucially, that deal was at nearly a 50% premium to where Kellanova shares were trading before the news broke. So when you look at Nomad Foods, this history just hangs there. It raises that question, is M&A, maybe even a takeover, always part of the underlying story here? Is it constantly on the table?
It definitely feels like it provides this structural kind of margin of safety for investors holding the stock now. And that feeling is really reinforced internally because the board and management together own a massive stake.
Yeah, 17.7%. That is huge.
It really is.
And what that does is create incredibly strong alignment. Their interests are totally locked in with increasing the share price, whether that comes from fixing the operations or, eventually selling the company.
So they're basically incentivized to push hard on whatever path gets the stock moving up, closes that gap between its current low valuation and what they think it's actually worth.
Absolutely. They're not just passive managers.
Okay, so let's shift to the actual products and where they sit in the market. What exactly is Nomad selling day to day?
Well, it's those big household names. Bird's Eye in the UK, Findus scattered across Europe, Iglo in places like Germany, Austria. And they specialize in frozen foods, meals, seafood, vegetables, meat products, generally aiming for convenient, high-quality stuff.
And the mix of products is interesting, too. It tells you where their focus lies.
It really does. It's heavily weighted towards nutrition. Something like 42% of their sales mix is protein, mostly fish and poultry. Think breaded fish, chicken strips, that kind of thing.
Okay.
And then another 25% is vegetables. So what this means practically is that over 90% of their revenue, certainly in the UK and Western Europe, comes from products that governments officially classify as a healthy meal choice.
So they're fundamentally tapped into that long-term health and nutrition trend.
You'd think so, yeah. They're well positioned there.
And what about the underlying market itself? How stable is frozen food in Europe?
Extremely stable. And maybe surprisingly, there's still quite a bit of room for growth.
Yeah.
It's a classic, stable CPG segment. You expect consistent volume growth, maybe 2–3% a year, and that's pretty much what it's done for the last decade, through recessions, through booms.
Okay, so predictable.
Predictable, but here's the really interesting part for this deep dive. The European market, particularly continental Europe, is actually quite underpenetrated compared to the US or the UK.
Underpenetrated meaning people in France or Germany just don't eat as much frozen food per person.
Exactly. Per kilogram, the consumption is lower. And that suggests this long-term sort of structural tailwind. As lifestyles get busier, people want convenience, but they don't want to sacrifice nutrition. So the category itself should keep growing.
Giving Nomad a built-in opportunity to grow volume.
Provided, and this is a big provided, they can compete effectively against the private label brands, the supermarket-owned brands, which have been getting much stronger.
Right, that's always the fight in CPG. Okay, one last point on structure before we get into the problems. Nomad's based in the UK, but they deliberately chose to list primarily on the New York Stock Exchange. Why?
Yeah, analysts point this out as a really key strategic decision. Listing in New York gives them access to what, many people call the best capital market in the world. It's deeper, generally less volatile than London, where a lot of their UK competitors are listed.
And that access to deep capital is crucial for
their whole financial strategy, especially the aggressive share buybacks we're going to talk about later. Having that NYSE listing makes that much easier and more effective.
Okay, let's pivot now to the sharp end, the challenges, the headwinds. And specifically, this very unusual story from their Q2 2025 results. That quarter really hurt. The numbers show the strain pretty clearly.
They really do.
Yeah.
I mean, despite that solid market position we just talked about, the quarter showed definite weakness. Revenue was down slightly, 0.8%, landing at $747 million.
Okay.
But organic sales, that's the number stripping out currency effects, the real health measure that declined 1.1%.
Yeah.
And that was almost entirely driven by a 1.0% drop in volume. People bought less stuff.
And the pain got worse further down the P&L, right?
It amplified. Adjusted EBITDA, their core profit measure, dropped sharply down 7.2% to $129 million. And adjusted earnings per share fell even more, down 9.1% to $0.40.
So less volume, less revenue, and significantly less profit. Why? Management was surprisingly blunt about it.
Astonishingly clear, really. They said the primary driver, the main reason for the shortfall, was, and I'm quoting here, the unusually long duration of exceptionally warm weather across Western Europe.
It just sounds so counterintuitive for a frozen food company. Like, who wants to cook when it's boiling hot?
Well, that's the twist. This wasn't just nice weather. This was extreme. June 2025, officially the hottest June on record across Western Europe. Spain, France, Italy, the UK all smashed records. Just look at the UK stats for spring. 73% more sunshine than average, 58% less rainfall. This isn't just about feeling warm. It fundamentally changes behavior, how people shop, how they cook, what they feel like eating.
Okay, break that down. How does extreme heat actually hurt a company selling frozen fish sticks? You'd think maybe people would want more easy meals, not fewer.
You're right about not wanting to stand over a hot stove, but that's precisely the issue for Nomad. See, the heat was actually great for some frozen categories. Things like ice cream, sorbets, their volumes accelerated, up something like 8% year over year in key markets. People wanted cold treats.
Makes sense.
But Nomad's portfolio heavily over-indexes, meaning it's concentrated, in savory frozen food, specifically stuff you typically bake in an oven at home. Think coated fish fillets, breaded chicken, frozen vegetables that go with the Sunday roast.
Ah, okay. So the weather screamed barbecue, eat outside, maybe grab takeaway, not turn on the oven for 20 minutes to cook a frozen dinner.
Exactly that. That differentiation really hurt them. Nomad's own analysis showed the weather created about a negative 2% volume headwind for the whole savory frozen food category. But because of their specific product, mix, all that bake-at-home stuff, the impact on Nomad's business was closer to negative 3%.
So they were structurally more vulnerable to the heat wave than the average frozen food company.
That seems to be the case, yeah.
And if the weather wasn't bad enough, they also got slammed by inflation, right? Squeezing margins.
That's the other shoe dropping. Their adjusted gross margin contracted really significantly, down 310 basis points, falling to 27.8%. And this was purely down to that price-cost lag.
Price-cost lag, meaning?
Simply put, the cost of their inputs, the fish, the chicken, the packaging, energy, went up much, much faster than they were able to raise the prices they charged the supermarkets.
What were the biggest cost pressures hitting them in Q2 specifically?
It was kind of a double whammy. You had general commodity inflation, poultry prices were specifically mentioned as a problem. But the weather itself made things worse.
Yep.
The heat and the drought actually hurt agricultural crops in Europe. So the cost of some of their vegetable ingredients went up more than expected, directly contributing to higher COGS, cost of goods sold. They were literally paying more for ingredients damaged by the same weather that was stopping people from buying the finished product.
Ouch. Okay, let's slow down here because this pricing issue is key. Why can't a giant company like Nomad just hike prices immediately when their costs go up?
That's just a tough reality of the CPG world, especially in Europe. It's a major structural hurdle. Management was very clear. Most of the price increases they've negotiated with retailers to offset these higher costs won't actually hit the shelves, won't take effect until 2026.
2026? Why such a long delay?
It's all down to the annual retail negotiation cycles. Nomad has to sit down with massive supermarket chains, think Tesco, Carrefour, Aldi, usually once a year, to agree on prices for the next 12 months. So if your costs spike mid-cycle, you just have to absorb that pain for potentially up to 18 months before your next negotiation allows you to pass those costs on.
So they were basically forced to just eat that margin compression throughout 2025, waiting for the 2026 price lists to finally catch up. That's brutal.
It's an unavoidable lag that really hammered margins this year.
Okay, so we've got the external shocks, weather, inflation. But let's talk about the issues the CEO, Stefan Descheemaeker, actually called self-inflicted. What internal execution problems did they admit to?
Yeah, he owned up to two main things. First, he said they too optimistic and basically moved too fast with their big enterprise resource planning, or ERP, system integration.
ERP, remind us what that is and why messing it up is so bad.
Think of ERP as the company's central nervous system. It manages everything. Forecasting customer demand, scheduling what gets made in the factories, ordering raw materials like fish and cardboard boxes, tracking inventory everywhere, handling logistics and shipping.
Okay, so it's critical.
Absolutely. And this integration project affected 4 of their factories back in Q3 of the prior year, causing significant disruption. If you switch over to a new system too quickly and it glitches, the factory literally grinds to a halt. It can't process orders, can't schedule production, can't ship products. The CEO basically admitted they pushed the IT change faster than the operations could handle. They've now had to slow that whole program down.
Right, you can't move the physical goods if the digital brain isn't working properly. Makes sense. What was the second internal issue they flagged?
Poor anticipation of inventory dynamics, particularly back in Q1. In volatile times like these, you need really good visibility into where your stock is in your warehouses, with distributors, on the supermarket shelf.
Okay.
The CEO admitted they didn't do a great job anticipating how inventory would move, or maybe needed to move, to cope with the volatility. He mentioned lacking visibility. This probably means they ended up overstocked on certain products, maybe the bake-at-home stuff, that then didn't sell because of the heat.
Tying up cash and potentially leading to write-offs or heavy promotions later.
Exactly. Not efficient.
It is worth remembering, though, that ERP failure from last year does create an easier comparison for the upcoming Q3 results, right?
That's true. That disruption in Q3 2024 caused about a 2.5% negative hit to sales back then, mainly in August and September. So when they report Q3 2025, they'll be comparing against that weak period, which should provide a bit of a temporary lift to the year-over-year number.
A small silver lining.
A small one, yeah. But ultimately, the combination of that huge external weather shock, amplified by these internal stumbles, was just too much to overcome in Q2. And that's why they had to lower their full-year guidance. Organic sales now expected flat to maybe down 2%, versus the earlier target of flat to up 2%.
And profits taking bigger hit.
Right. Adjusted EBITDA now expected to decline somewhere between 3% and 7% year-over-year, compared to the previous guidance of flat to plus 2%. It shows the scale of the impact.
Okay, so things were tough, guidance down. But management clearly isn't just sitting around hoping for cooler weather next year. They laid out a pretty robust turnaround plan. It seems heavily focused on innovation and leveraging specific parts of their portfolio that are working.
Absolutely. This isn't just wishful thinking. They pointed out that despite all the headwinds, they actually managed to stabilize their market share. And their retail sellout, what's actually selling through the supermarket checkouts, was up almost 1% year-to-date through the first half.
So underlying demand for their brands isn't collapsing. The commercial plans seem to be getting some traction.
That underlying stability is definitely encouraging. And their stated goal is still very much a return to organic sales growth in the second half of 2025, assuming, the weather gets back to something like normal.
In the strategy to get there.
It's focused on what they call their must-win battles, basically. Strengthen the core brands people already love, drive more operational efficiency, cut costs, and, this is the big one, dramatically accelerate innovation.
Why the huge push on innovation right now?
Two reasons, really. One, to defend against those cheaper private label options that always gain ground when consumers are squeezed by inflation. Two, to capture new growth from changing consumer trends, like health and wellness.
And the scale of this acceleration is pretty striking in the materials we reviewed.
It really is. They're targeting innovation, brand new products, and renovation, significantly improving existing ones to account for something like 16% to 17% of total sales in 2025.
16 to 17%. Wow, compared to what?
Compared to about 10% in 2024. That is a massive jump. When a company shifts its focus so heavily towards new or reformulated products, it signals a major strategic pivot. It's high stakes.
So renovation is about making sure their bird's eye fish fingers are still better than the supermarket's own brand, even if they cost a bit more?
Exactly. Winning on taste and quality against the cheaper option. While the innovation piece is about launching entirely new things to capture premium growth, maybe from younger or more health-focused consumers.
Okay, let's look at a couple of specific examples they highlighted launching in the second half of 2025. First, theirs get real protein bowls. What's the angle there?
This is clearly targeting that younger, health-conscious demographic. People looking for functional food that does something specific for them, like deliver high protein.
Right.
These bowls are apparently designed using careful ingredient selection to pack in a lot of protein, they mentioned, up to 35 grams per serving, but with cleaner ingredient labels than you might typically find in a frozen ready meal. They're launching first in the UK, Netherlands, and Belgium.
And 35 grams of protein, why is that number significant?
It pushes the product firmly into the performance or serious nutrition space. It's positioned potentially as a post-workout recovery meal or just a really substantial, satiating main course. It moves beyond just convenience.
Trying to capture people who might otherwise buy expensive meal kits or those high-protein ready-to-eat pots.
Precisely. Especially in the UK, where Nomad's share in frozen ready meals is actually relatively small, this looks like a major attempt to build a new platform and grab those high-value consumers.
Okay, second big initiative. Renovating the Goodfellas pizza line. This sounds more like shoring up a core category.
Definitely. They're launching a new and improved New York-style pizza line in September. Management sounded really confident, saying things like, the new products are much better than what we had before based on consumer testing.
So balancing the health focus with making sure the indulgent stuff is still best in class.
Exactly. You have to compete on taste and texture, too, especially against private label pizza, which can be very cheap. This is tackling that value equation head-on. They're also doing other things, like expanding their Captain Discovery's fish line and even launching a fish bar brand focused on snacking in Italy. So trying different formats, too.
Beyond the brand new stuff, what about the existing parts of the business that are already working well, these growth platforms?
Prepared poultry is the absolute star here. It's the key growth engine. Chicken is still generally the most cost-effective protein for consumers, so it's super relevant when budgets are tight.
And they've had big success somewhere specific.
Italy has been phenomenal for their prepared poultry. Retail sales there grew an incredible 52%, and they grabbed an 18% market share. Just huge growth.
Wow, 52%. They clearly hit a sweet spot in Italy. Where's the next big opportunity for poultry?
Germany. That's where they see massive runway. Despite all their success elsewhere, their market share for prepared poultry in Germany is still tiny, only about 2.5%.
So potentially replicating that Italian success story in a much bigger market.
That's the goal. The potential there is substantial.
Okay, another platform they mentioned was potatoes. Seems basic, but why is that strategic for Nomad?
Couple of reasons. One, obvious cross-sell potential with their iconic fish products, fish and chips. But maybe more importantly, frozen potatoes actually tend to sell better in warm weather compared to, say, a heavy lasagna.
Ah, interesting. More versatile.
Yeah. And the numbers back it up. In the UK, their frozen potato retail sales jumped 21% year over year recently, and they gained 180 basis points of market share. So potatoes are now seen as part of their strategy to be a bit more resilient to warm weather spells.
And they're seeing success elsewhere, too.
Yeah, even in seasonal stuff like ice cream, they mentioned gaining share in places like Serbia and Croatia, competing well against giants like Unilever's Ben& Jerry's in those markets.
Okay, so they're learning from this heat wave experience. What concrete changes are they making, assuming this kind of climate volatility isn't going away?
They're actively rewriting the playbook for warm weather. Things like changing their merchandising in stores, pushing products like natural fish fillets or recipe fish, and potatoes, which hold up better in the heat.
And promoting different ways to use their products.
Exactly. Actively pushing barbecue recipe ideas, using their frozen items, trying to reposition some products as ingredients for outdoor cooking, not just things you bake indoors. It's a clear recognition that this isn't a one-off freak event anymore. Climate volatility has to be baked into their operational planning now.
And underpinning all this growth and adaptation is a continued focus on just running the business more efficiently, cutting costs.
Absolutely. They're not just relying on sales growth to fix the profit picture. They highlighted that SG&A, cost selling, general, and admin expenses were down 11% year over year in Q2.
How'd they manage that?
Partly through straightforward overhead reduction, but also, interestingly, lower bonus accruals because profits were down. That actually helped offset some underlying cost inflation elsewhere. And they signaled they're doing a deep dive on their cost base now, looking for more significant structural savings beyond 2025. They plan to talk more about that later in the year. So definitely a focus on discipline, too.
All right, let's connect these operational plans to how they actually create value for shareholders, because this is arguably where the story gets really compelling, especially given that leadership background and the huge insider ownership we talked about.
Yeah, with the stock trading where it is, quite low, their capital allocation strategy is under a microscope, and it's very focused.
And that 17.7% collective stake held by the board and management really sharpens that focus, right?
Absolutely razor sharp. Management has been very clear. Right now, acquisitions are on the back burner.
Why is that?
Purely financial logic. Nomad's own valuation, measured by enterprise value to EBITDA, is sitting around 9.8 times. Buying other CPG companies usually means paying higher multiples than that. So at their current valuation, buying other businesses simply wouldn't be accretive. It wouldn't add value on a per-share basis. It makes no sense to buy expensive assets when your own stock looks cheap.
So instead of buying other companies, they're buying their own, aggressively.
Exactly. Share buybacks are seen as the absolute best use of capital at the current share price. They repurchased $100 million worth of their own shares just in the first half of 2025.
How does that compare to before?
It's a massive step up. That $100 million is a 132% increase compared to what they bought back in the first half of the previous year. Management described it as a heavy, heavy pace. It shows real conviction that the stock is undervalued.
And buying back shares reduces the total number of shares out there, boosting earnings per share for the remaining holders.
Precisely. It's a direct way to return value when the price is low.
They're also using dividends strategically, aren't they, to attract a certain kind of investor?
Yes, that's the other piece. They only started paying a dividend in 2024, and they already increased it by 13% back in February of this year.
Why is starting and growing a dividend so important in the CPG world?
It's about attracting long-term, stable institutional investors. Many big investment funds and, crucially, stock market indexes have rules about dividend history. Often, a company needs a 5-year track record of consistently paying and ideally growing its dividend to even be considered for inclusion in key CPG or dividend-focused indexes.
So by starting the clock now and increasing the payout, Nomad is basically laying the groundwork to get onto the radar of those big index funds a few years down the line.
Exactly. It's a long-term play to broaden their investor base and potentially increase demand for the stock.
Okay, dividends and buybacks returning cash. But let's talk about the cash generation itself, and critically, the debt side of the balance sheet, because that seems to be a key factor holding back the valuation.
It really is. Nomad is a great cash flow generator, consistently throws off around $250 to $300 million in free cash flow per year. Their conversion of profit into cash flow was decent in the first half, 43%, and they expect it to be over 90% for the full year. That's strong.
But the debt?
But the debt level's definitely something investors focus on. We look at the specifics here. Total debt is pretty stable at around $2.1 billion. But that translates into a leverage ratio, which is net debt divided by adjusted EBITDA, hovering somewhere between 3.7 times and 4.0 times.
And how does that compare to other big CPG companies?
It's high. Most large CPG peers aim to keep their leverage below 2.5 times adjusted EBITDA. Anything much above 3 times tends to make analysts and investors a bit cautious.
Why? What's the risk of higher leverage?
It just means the company has less financial flexibility. It's more sensitive to bumps in the road, like interest rate increases or a downturn in earnings. And the market generally penalizes companies with higher leverage by giving them a lower valuation multiple compared to their more conservatively financed peers. That's definitely part of the story for Nomad's current valuation.
Okay, can you break down that $2.1 billion debt structure for us? Where is it sitting?
Sure. It's spread across a few different instruments. There's a U.S. dollar loan of about $693 million. Management estimates the interest rate on that is around 7%, though they do hedge it into euros to manage currency risk.
Okay.
Then they have two main euro-denominated loans. One is for $553 million at a rate of 4.90%. The other is a smaller one, $130 million at 5.90%.
Those rates seem broadly in line with current markets. What about longer-term fixed-rate debt? That provides stability.
They do have a significant chunk of that. There's $800 million in senior secured notes. And crucially, these notes have a very attractive, low fixed interest rate of just 2.5%.
Wow, 2.5%. That's great in today's environment. When are those due?
Not until 2028. So that low-cost debt provides a lot of stability for the next few years. But obviously, when 2028 rolls around, they'll likely need to refinance that chunk of debt at whatever the prevailing market rates are then, which will almost certainly be higher than 2.5%.
So a complex structure typical of a business built through acquisitions and maybe private equity involvement historically. Okay, so summing up the valuation picture, strong cash flow, aggressive buybacks, a growing dividend starting from a low base, but offset by higher than average leverage. The current PE ratio is noted as being really low, around 8 times earnings, and the free cash flow yield is strong, roughly 10%. What's the general outlook from analysts?
Well, this sort of conservativist base case forecast, assuming management pulls off the stabilization plan, is for maybe a 10% total annual return for investors.
Yeah.
That comes from combining modest earnings growth, maybe 5–7% per year, with the impact of the share buybacks and the dividend yield.
Okay, decent baseline.
Decent. But the real potential upside, the thing that could really move the needle, is if the market starts to believe in the turnaround story and gives Nomad a higher PE multiple, closer to the average for the CPG sector. That re-rating is where the significant share price appreciation could come from.
And if that re-rating doesn't happen quickly because growth remains sluggish, we come full circle back to where we started, a takeover potential.
Exactly. Analysts consistently mention this. That potential M&A scenario, remembering that Kellanova precedent set by Tom's Capital, acts as a crucial backstop, a margin of safety. If the internal turnaround takes longer than hoped, the combination of that high insider ownership, the low valuation, and this portfolio of really strong, dominant European brands makes Nomad an exceptionally attractive target.
For any big global food company looking to just buy the leading position in European frozen food in one go.
Precisely. It's a consolidation play waiting to happen, potentially.
Okay, so let's try and pull all these complex threads together for you, the listener. What's the bottom line here? Nomad Foods looks like a fundamentally pretty stable business. It operates in a good category frozen food, which has advantages, and is actually structurally underpenetrated in large parts of Europe.
Right. And the operational problems they faced recently, the ones that caused that Q2 earnings miss, they don't seem systemic. It wasn't like consumers suddenly rejected Bird's IPs. It was mainly driven by that really unusual, severe external shock, the extreme heat wave, which was then made worse by those internal but seemingly fixable mistakes with the ERP rollout and managing inventory.
That really feels like the core synthesis. Management seems to get it, they've acknowledged the problems, and they're taking pretty significant actions themselves, slowing down the risky ERP project, cutting overhead costs aggressively, and making that huge pivot towards innovation, pushing new and improved products from 10% up to maybe 17% of sales.
Yeah, that innovation push is key. It's designed to tackle both things, appealing to modern consumers focused on health and fighting back much harder against the threat from cheaper supermarket-owned brands.
But despite the confidence in that turnaround plan, the unexpected hit they took in the first half from the weather just forced them to reset expectations for the full year.
Exactly. That's why they revised the 2025 guidance down.
Yeah.
They're now guiding for full-year organic sales to be somewhere between flat and down 2%. And adjusted EBITDA is expected to decline between 3% and 7% compared to last year.
And they specifically mention building in some caution there.
Yeah, management said they deliberately structured the lower end of those new guidance ranges, the -2% sales, the -7% EBITDA, to provide a bit of a buffer. Some flexibility in case there are more unexpected bumps, particularly, if the unusual heat waves persisted through the summer, which they seem to have done after Q2 reporting.
Okay, which brings us perfectly to our final thought for you to mull over after this deep dive. Nomad Foods has really shown us something important here. Even a leading company in a supposedly stable category like frozen food, whose whole business model relies on predictability, now has to treat climate volatility, specifically this trend of increasingly record-breaking hot summers in Europe, as a genuine, ongoing operational risk.
It's no longer just a freak event. So, the provocative question is, if this trend of extreme heat does persist, if these hot summers become the new normal, how fundamentally will Nomad Foods have to change its product portfolio? Can they just tweak around the edges with barbecue recipes and selling more potatoes? Or will they eventually need to move significantly beyond their traditional core, the bake-at-home fish sticks and peas, to truly align with what might become a permanently warmer, more outdoor dining-focused continental European diet?
The current innovations in poultry and the focus on potatoes show they're adapting, for sure. But a permanent climate shift, that could force a really radical rethink of what it means to be Europe's leading frozen food company. A fascinating challenge ahead.